All right, today, guys, I'm going to try to be quick with it. It's I've got kind of a new-ish theory about how to go about figuring out how to manipulate the stock market, or how it gets manipulated already by big institutions, so that you could piggyback off their trades and make a profit. And I've already talked about how the opening price levels from various major stock exchanges around the world, as well as like 8:30 a.m. Fedwire T+1 settlement. These levels become good rejection levels. They're not always perfect. Actually, they're often not perfect, but there are times where they are perfect as well, and that's where it's really powerful. But it's hard to determine exactly when it's going to work perfectly, like it did right here, where Fedwire opens, it trades below it, fails to be a short, but then from the long side it retaps it as a long. But the success rate isn't always high of something that, where, like, depending on how tight your stop is, it's not always going to be a high success rate. However, when it does succeed, the moves are absolutely massive. So you could probably figure out some sort of risk to reward if you use statistical analysis really deeply to figure out, what the RR you should go for is when price is hitting these levels. But anyway, on to what I want to talk about today is, okay, price moves more easily through areas where there's less resting orders. Okay, and so what I mean by that is, let's say I'm going to try to draw a squiggly price line, right? I don't use the drawing tools too much on this. Okay, I think this is a path. But let's say price is just kind of going like this in an area, right? Okay, but let's say that right above this level, there's less sell orders. Okay, if there's not a lot of sell orders in this area right here, the same amount of buying. Okay, how do I make it done? There we go. Okay, so let's say there's lots of sellers and lots of buyers in this area, but they're fairly equal. Well, price will just go back and forth, right? When price hits, now this may seem obvious to a lot of you, but it's really important to think about it. Okay, when price gets to an area where, if buyers keep stepping in and there's not sellers stepping in, price will shoot up through that area, right? So here's what I think institutions do. If they have enough power to manipulate price to a large degree, if it's a large enough institution with big enough buying power, what I would imagine they would do is they would slowly, piece by piece, accumulate a position. So they'd be buying some here, 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 here. But they'd be buying in pieces, not too much volume. They don't want to move price too much, right? So they buy in chunks. Then, when they're able to determine that sellers are beginning to exhaust, they sacrifice more of their money. They sacrifice some of their money to move price so that the positions that are already existing go into profit. Right? So let's say that an institution has 500, or let's say they've got $5 million worth of shares. I'm just throwing out an arbitrary number. Let's say they've got $5 million worth of shares here. Okay. Now let's say they use another $2 million worth of shares, or 2 million, sorry, 500, what did I say? $5 million worth of shares. Let's say they use another 2 million once sellers are exhausted in this area. And the 2 million that they use here pushes price up. So they have no profit, even actually small loss, on the $2 million they used to pump price. However, the $5 million worth of their positions over here are now in enough profit to way offset, and then plenty, the losses they incurred by using $2 million more to push price up, right? So they push price up, they sacrifice some of their money to push price up, but it actually makes them money on these positions, and then they profit. They sell all the positions for a profit, they dump it, and then price will most likely come all the way back down to here, because the only thing that moved price up was their position. So as soon as they sell all their positions, price will go back down to here, basically, right? I think in a nutshell, that's what trading really is. So if you want to succeed at trading, that means you would have to find a small enough pond for your assets where you can move price in the same manner, where you could cheaply accumulate a position in secrecy and then sacrifice some of your money to pump the market up, driving these positions into profit. So you use some of your money as ammo to reward the other part of your money, and you sell it off to people that are FOMOing in up here. And I mean, well, whatever you use to catalyze the price movement here, it doesn't necessarily have to be your own money, right? Because if you think about pump and dump schemes, it's the same thing. And this is what you have to learn about trading, is that all of trading is pump and dumping, or dump and pumping, right? You're trying to get the best of other traders by outsmarting them. Because it's a zero-sum game. Your profits are other players' losses. It's that simple. So you could use social media and hype to pump price up by using other people to move it into profit for you. That makes it even easier to make money in a more cost-effective way. However, that's fraud. But it's a gray area, and a lot of the time, a lot of people get away with pump and dumps, especially in crypto nowadays, because it's not super heavily regulated, and it's kind of a gray area about, what is a pump and dump. There's times where certain behaviors are definitely considered a pump and dump and are prosecutable by, the relevant regulatory department, whether it's like the CFTC or the SEC. You can go to jail. However, there's other types of pump and dumps where you basically won't go to jail for it, because it's either you didn't take enough money from people, or the way you went about it wasn't exactly breaking the rules in the way that they've been specifically technically established. So a lot of pump and dumps, especially in crypto, people get away with them. To me, it's obviously unethical, so I would never do it that way, by hyping up something and then dumping. But however, the first method that I established, to me, I think is actually completely legitimate, because all you're doing is buying and selling orders in various sizes at various places. There's nothing wrong with that. If you have the firepower to move price in favor for positions that you already have, I think that's what trading is supposed to be, actually. So to me, that's totally ethical, because what's the point? You're not breaking any rules. You're not even communicating anything to anyone. You're just buying and selling. But I don't know, guys. Let me know your thoughts on that. But to me, it seems like, let's say you found a very small crypto where there's not a lot of traders in it, and then you begin accumulating a massive position here, and then you moved price in your favor with more of your money, way in your favor, buy, and then you dump. You don't make any profit. You actually take a small loss on all the money you used to move price, but the positions, like I said, that were already existing at a lower level will win. And what I think is that big institutions, this is how they work. But however, since they don't all collude with each other necessarily, right? They're actually competing against one another. So what I think trading is actually, it's the intermingling and competition of various whales and institutions of various sizes, all trying to do some form of this to the degree that they can get away with it. And I don't mean legally, I mean because it is legal to do this. They're doing it to the ability that they have to do it, right? A smaller institution can't move prices far, so they might have to do this in a way where they're scalping, or they're just going for smaller targets, or they might be trading during a time where there's less volume and it's easier to push price with big size, right? So the Asian session hours, if you're a small player, it's probably easier to push NASDAQ around in your favor rather than, any time between 9:30 a.m. New York time and, 3 p.m. New York time, right? Harder to push price during that time, right? From from the window between this giant volume candle in the morning and this giant closing candle, it's harder to push price at anywhere during this point of the day. Okay, during this point of the day, from basically, let's just say when futures opens again at 6 p.m. Eastern time, up till about, let's just say about 8 a.m., 8:30 a.m. Eastern time, it's probably easier to move price in your favor here, right? I don't know, just my 2 cents. Obviously, I would not successfully be able to push price on NASDAQ at any time of day with this size of my account right now, which is why I was saying you might, if you were going to use this method of trying to trade, you would have to find you'd have to be a big fish in a small pond, okay? And you would have to increasingly move to bigger and bigger ponds as your bankroll grows. But I don't know if anyone's ever tried this, succeeded, failed with it, has any insight or a rebuttal or something they think that this wouldn't work. You know, they feel free to say something in the comments. But to me, think about it. It doesn't matter, you know, who's buying. It's how much size they're buying with and how are their orders being absorbed or not. Because if you can find a place where you can accumulate a position in stealth and then just pump price by just buy, or, you know, drop price by sell, you drive it into profit for your other positions, and then you can close all your positions for a profit. Obviously, you don't make the full profit because, like I said, it's going to cost you some to push price that far for you. But if you accumulate a large enough position before pushing price, you can win. Now, obviously, it's unpredictable. You don't know what other players are going to do to push price too, so that's not a guaranteed way to win necessarily, but I think that is literally the difference between retail and institutional trading is that knowledge right there, that the ability to push price, that using money, you could make money off of other positions you already have. You can push price into favor for pre-existing positions. And I think really that's all it is. It's just, are you aware that that's how to win in trading, or are you not? And if you are, you have to find a pond that's your size. But yeah, basically anyway, that's kind of all I have for today. It's not technical. It's just a very conceptual, strategic, big picture type of strategy. The nuances of how one could utilize that in situations, I don't know. But I guess that's what I'll be looking into going forward. But anyway, this video is about 13 minutes, so I think it's about long enough. So take care, guys, and I'll see you next time.